In this video, we'll be going over the best crypto trading bot platforms and the type of bots that they offer. So if you use any of these platforms, how do these bots actually work in the real world? Well, I've got some real data here from bots that I've been running for well over a year at this point. So I'll show you exactly how they work and if they actually do what they're supposed to do. Firstly, which platform should we use to get the best trading bots? Well, actually, all of these trading bots are exactly the same in the way that they work. They're just programs that do something, and the strategies are the same across every exchange. Binance and OKX are the top 1 and 2 exchanges in the world. And so if you want to use the bots on here, it's just going to be easy to do that with all of the other stuff that they have as well. Pionex is a specific trading bot platform. A lot of people use it for the trading bots, but again, all the bots on here you find on other exchanges as well. So whether you use Binance or OKX or any other exchange, as long as it offers these bots, you're going to be getting the same thing. I'll leave links below to all of these platforms. I use them. And if you are new on the platforms, you can get deposit and trading bonuses. So you can check the links below for the details if it's available for you. The first bot we'll look at though is recurring buy, otherwise known as dollar cost average. But on most of these bot platforms, it actually gives the name as recurring buy and not dollar cost average. What is recurring buy? You just set this up to automatically buy the crypto that you want at regular intervals. So you put some money on the platform and you say, every month or every week, I can simply buy $100 worth or $500 worth, and it's just going to do that over time. Very simply, the way you set it up. So you go to the recurring buy bot, you say, yep, I want to buy Bitcoin and I want to buy, at a regular interval. So I want to buy weekly on a Monday at 12 local time, and I want to buy, $100 a week. And so as long as you have some stable coins in your account or some money on there to actually go ahead and buy this, it's just going to regularly buy. This is great because dollar cost averaging is a really great strategy. Now, I would dollar cost average through bear markets and drawdowns. The two ways to buy crypto is either dollar cost average, otherwise known as recurring buy, or lump sum. Neither is better or worse. It just matters that you buy the most crypto at the lowest prices. So we can't know when that is, but during a bear market when prices are lower and prices are falling, that's typically a great time where people will dollar cost average. These times typically last about 18 months or so. So if you're seeing that we're in a bear market and things are pretty low or getting lower and the price is weak, as long as you want to accumulate that asset, you can just set this up, or you can do it manually as well. But this takes a lot of the emotions out of things. So you can set it up for a couple of months or 6 or 12 months to do that. So it's very easy and it takes the emotion out of things, but it's not a better system. If you're in a bull market where prices are rising, you want to be going with lump sum potentially, because if you're dollar cost averaging at higher prices, then the average price that you pay, known as your cost basis, is going up. So neither of these strategies is good or bad, but obviously it's a bot that you can use mostly for bear markets where you want to accumulate crypto as prices are going lower. Another type of bot that uses this strategy is called the Martingale bot. You may see it on your platform as DCA bot. So don't get confused between recurring buy and DCA. These are actually different strategies. So if we click on the OKX trading bot here, which is DCA, recurring buy we've just seen, but DCA is actually an active trading strategy, and it's going to do things in a little bit of a different way. This infographic really tells us how it works. And so what you're doing here is trying to buy a dip in the price and then wait for the price to come up and actually sell it, actively sell it at a price that's higher than you got in. So this is an active trading strategy. It's one where you want to take advantage of dips. Now in bull markets for crypto, we get these dips a lot. So as you can see here, during this bull market, and it's a huge rise in the price of Bitcoin, what we see is that there are regular drawdowns of, let's say, 20% or so, and you get them here. Now, if your strategy is, I'm looking to accumulate BTC or any other crypto, I want to accumulate it, I think we're in a bull market, and so I think the price is generally going to be rising, but there are dips during these bull markets all the time. And so I want to try and selectively buy those dips. Now, you can sit at your screen all of the time, but obviously that's not going to work for all of us. So the Martingale strategy, or this DCA strategy, essentially tries to buy those dips. And so you can set it up to say, if we dip 5%, I want to buy. And if we go down another 5%, I want to buy again. And then the third time, right? And so what it's doing is, you can set this up as you want. So every 5% move down, I have another buy. And you can set it up to actually buy 10 at this point, 20 at this point, and 40, or whatever you want, right? So you're actually buying more as the price comes down. And so what you're really doing here is trying to enter into an active buy the dip trade, but the bot's doing it for you to try and get a better entry price rather than just, seeing it dip down and say, I want to go in now. And so you're trying to get a better dollar cost average price. And what usually these DCA bots do is actually put a sell price in as well. And so on these dips, what it will do is buy once, twice, 3 times. And then as you go up, you can set that to sell the crypto that you've bought at this price. And so you can set this up to any price that you want, but it's a more active strategy. So what you would do here on any of these systems is, as you can see, go to the trigger settings. How much do you want to invest? And which percentage do you want, right? So for right now, there's 8 orders, as you can see. So these are split up at 8 different price levels. Let's just switch this down to 3. And now there are only 3 price levels. You can set them up. So it's an active strategy, definitely. Maybe in bull markets it works because you are thinking the price generally is going to rise, but you want to kind of buy dips. So it's a strategy that's active. And if you are looking to trade dips or, try and selectively get in and try and take advantage of that, then this, again, takes the emotion out and just gives you these specific trades. So it may be good for that use case. The next type of bot we'll look at is an algo bot, sometimes known as an order bot or a slicing bot. These just help us split up our orders and get a decent trade in comparison to what the market has traded around that time. And so if we go to Binance as an example, you can see the Algo bot right here. So if you press create, what we're doing here, if we choose Algo orders, is trading an amount of a crypto. So let's say we want to trade, 1 Bitcoin or something like that. But you don't want to trade it all in one order, right? Because, that day you have no idea what's going to happen. So what you can do is set up a TWAP, or a time weighted average price. And what that's going to do is trade the crypto over the given time frame that you set. And what you're trying to do is get a decent price for your trade in comparison to what the market traded, right? Because if let's say you buy here, right? Well, that was a bad trade because throughout the day, the price was much lower than that. And so what a time-weighted average price bot does is just split up the orders and say, well, we're going to trade like 0.1 every hour. And so we're going to get an average price for our trade, which is, similar to the average price that was traded throughout the day. And so you're going to, buy or sell some at different prices. And the yellow here is your average, average price. And so it can just split up and get a decent average price for your trade in comparison to what was traded over a given time. You can do TWAP, which is time weighted average, and then put in the amount of hours, that you want to trade. POV is percentage of volume. So what you're looking at is whenever the volume is traded, your order is going to be a part of that. And so the more volume that's traded, you will trade more of your order. The less volume that's traded, you're going to be trading less. And so what you're trying to do is get the average price for your trade in line with what most other market participants were trading at that time. This is usually good for larger orders. If you're if you're trying to trade a larger order in a kind of shorter time frame, then people will use this type of bot. The next type of bot we'll look at is an arbitrage bot. This is a really popular strategy. Hedge funds have done this for a really long time. But with crypto, it's pretty easy for us to do this now. So if you click on arbitrage, I've seen this on OKX and Pionex. I haven't seen this on Binance's yet, but they may have it in the future. This carries out a really popular strategy. So I'll explain what the strategy is. So what we want to do if we want to carry out this bot is take advantage of a yield that is paid to us from the market, but we want to hedge out our price exposure. So we're going to go long Ethereum and buy and hold that asset in our spot account. It's actually staked Ethereum because that's the staking token. So you can stake Ethereum and it pays you 3.5% yield as of making this video. That changes over time, but let's say it's 3.5%. So we go long ETH and we're getting 3.5% yield. But of course we have price exposure to ETH. Now that's been really great as well because ETH's gone up a lot and it's a strong asset. But this strategy is taking out that price exposure. So what we would do is take a position in the futures market, which is short. So we're long 1 ETH in the spot market and we're short 1 ETH in the futures market. So that creates what's known as a delta neutral position where you're long and short the exact same amount of ETH. So if the price goes up or down, one of your positions is going to be canceling out the other position. And so we have no price exposure to the price of ETH, or little price exposure now. But we're still getting the 3.5% from the staking rewards. And in the futures market, there's actually something called a funding rate as well. And if this is positive, you'll be earning the funding rate if you've got this short position. So if the funding rate is positive, that means short positions receive this. So you could be getting another, let's call it 5% a year from the funding rate. Now funding's a little bit weird because it can actually be positive or negative. And so if you're short and the funding rate is positive, you get the funding rate. But if the funding rate is negative, you actually have to pay that. Most of the time in crypto, I would say, especially for the larger assets, it's mostly positive. Throughout a year, if you hold it for a year, for example, you may come out at some blended price that's probably in your favor, but it's going to change depending on the asset. So what you can see here, this strategy is it's basically gaining the yield from this without price exposure of the underlying asset. Now, generally with really great assets, they go up in price. And so you actually want price exposure, right? To like Bitcoin and ETH, you probably want price exposure over the long term. And so that's up to the individual. But this strategy aims to take out price exposure, but arbitrage the yield that you're getting from the long position and any funding position. As an example here, you can see we're in the arbitrage trading page. Up here, if you click this, it's going to give you a list of all of the assets that are paying the highest funding right now. And so what you can see is that you sell the futures, get that funding, but you cancel out your price exposure with buying the spot. And this one here we clicked on, right? So the APY right now is 27%, which is amazing. So you're getting 27% without much price exposure, just getting that yield. What it does is it opens both legs for you at exactly the same time. You open the short position and then a long position, and you have to obviously get the exact same amount or very close to cancel each other out. This is a great bot to do that. Now, that doesn't say anything about how good this strategy is. For example, in a bull market, you just want to be long stuff because it goes up way more than what you'll be getting from funding. And in a bear market, maybe you want to be dollar cost averaging. Maybe it's better to actually get the yield out. So you still have to make that decision. It's down to the individual investor. But as a bot, this lets you do it, really specifically, accurately, and very easily. I've actually got an OKX video that goes through exactly how to use it. So I'll link that down below as well. Next, we'll look at grid trading bots, which are probably the most popular. I've had some grid trading bots running for about 1.5 years at this point. I opened both of these specifically just to show everyone how they actually work and if they're actually any good. And so I'll go through the results of these and some of my opinions on them. I'm just going to leave these running forever and, just show people how they work in the real world. So what is a grid bot? Very simply, you buy and sell actively. The grid does that. So you buy, and as the price comes down, you buy. And then as the price comes up, you sell. And then if the price comes down again, you're going to be buying and selling and just going over and over again, refreshing all of the orders over time. And so what these bots aim to do is, buy and sell, a 1% move, and the profit from that 1%, they just keep it out. And so they're just going to be actively buying and selling all of the time, right? And so what you have to do is you have to set an upper bound and a lower bound for the bot to trade within. You have to give it some money and then say to it, you can trade every 1% or every 2% or whatever it is, and it's going to just buy and sell in that, constantly refreshing the buys and sells. The aim here is to try and make money from volatility within the price, right? And so as long as the price moves up and down here like this, you're going to be buying and selling all of the time and taking profits out. So are these bots actually good, or when should we exactly use them? So let's have a look at the bots that I've had running for a while now. So in the previous bot update, both of these bots were in the red by about 30% or something like that. And I think they went down by much more than that at the bottom of the bear market. We've had good price rises now, and so both bots are in profit. The Ethereum bot is basically break even, and the Bitcoin bot is up 30%. So as you can see, what they've done is I've got grid profits here. And that means that the trading bot has been working, and it's made me a 5% yield from buying and selling. So that's something I wouldn't have had if I was just holding the asset. You can also see here that we have price appreciation of the Bitcoin that we've bought and held. So that's up as well. So the blended yield is about 30%. For ETH, it's the same sort of thing. Actually, the grid profits from ETH are about $46 or 3%, and we're actually in a loss on the Ethereum that we bought because we bought at a higher price. And so the bot has put me in a profit even despite the Ethereum that we bought is in a loss. So hopefully you can see they do work to take profits out of grids. But that's not really what we need to compare. What we need to compare is how do they work versus just buying and holding, or going through different types of strategies. So we'll look at the reports or the performance right here, which you can see. This was the last video I made and what the performance is. So if I would have just bought the crypto in a lump sum when I started the bot, I would have lost this money on both of these bots. So you can see the entry prices where I started the bots and the time that I started. So if I just bought Bitcoin and ETH at these price levels, when I made this video last, which was back in the bear market, I would have just lost money on that investment. The grid bot actually outperformed both of the crypto lump sums, right? So the performance was better from using the bot than just buying in a lump sum. However, the DCA strategy would have outperformed the bot. So if I'd have taken that lump sum that I was going to invest, split it up, and just invested every week, right, then I would have made better returns by doing that dollar cost averaging strategy. So the bots do exactly what they say they're going to do, which is take profits out of grids, but DCA would have been a better strategy, lump sum would have been a worse strategy. This is how they've performed now that we've had some really good price appreciation, over the last 6 months or so. So again, the lump sum on these, as you can see, lump sum would have netted me plus 31% for the Bitcoin, down about 8% for the ETH. For the grid bot, it's up 31%. So it's actually about the same as lump sum. So even with all of the grid bot trading and profits, it hasn't outperformed lump sum. And on Ethereum, it has outperformed lump sum a little bit. I think the reason for this is because with the Ethereum bot, when you're trading, you are gathering Ethereum at lower prices, or at least I did through the bear market. And so it was able to buy Ethereum at lower prices. And because the actual price of Ethereum in the market right now is around 2,800, which is below the lump sum, that's why it's outperformed, because it's been able to buy at those lower prices. But it seems like when the price rises again back up, it doesn't really outperform lump sum at all. Now, you can see that the DCA strategy, again, would have massively outperformed both lump sum and grid bots. So the reason for this is because both Bitcoin and ETH are, volatile, but growing. And so the best strategy, it seems, with an asset that's going up in price a lot with huge volatile downside moves, is to dollar cost average or buy every week in bear markets. You're going to accumulate more of the crypto at lower prices and keep it and hold it. And then when the price does move up again, you make very big gains. So it looks like grid bots dampen volatility, and they do take those profits out of the market. It's not good or bad, it's just a bot. And so really what it's useful for is if you know between point A and point B that you're going to be the same price, right? So point A and point B, you have the exact same price. In between, you want it to go like this, and you want the grid bot to try and take some profits out. And if you think that's going to happen, then the bot is probably going to be a decent bot for you. Now, again, with trading bots or grid bots, the parameters you set are really important. I set these bots at having huge grids and trading very small amounts in between. And so it's going to be trading very small amounts, and therefore the profit per grid is going to be pretty small. You can be way more active with grid bots and put the upper and lower bound much closer, and you may actually make way more out of the volatility. But that's for a separate video, because that's really going into the strategy of that. I've got some videos on that below, which I'll link, but it's up to the individual to really understand how they work and then how to implement them properly.